The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. UK inflation data is hitting the wires, and I can tell you, just having a quick look, that June services CPI up 3.6%. The headline figure, though, has come in at 2.6%. That is in line with some expectations I've seen. Some were looking at 2.7%. So relatively tame, the inflation hitting the tape as new Prime Minister Andy Burnham vows to practice fiscal discipline, rolling back VAT on electricity bills and facing calls to extend tax breaks for young workers. The PM saying his aim is to raise living standards.
We need to be a cost of living.
Three tankers carrying Saudi oil are forced to U-turn in the Red Sea amid Houthi threats as a new front opens up in the US-Iran conflict, putting further strain on crude supplies and pushing prices higher.
Samsung is reportedly in talks to invest up to €1 billion in French AI firm Mistral in a fundraising round that could value the startup at around €20 billion. Santander says it is on track to meet its targets for the year after underlying net profit jumps by nearly a fifth amid higher revenues and 2 months of contributions from the British lender TSB. We'll hear from the CFO later this hour.
Despite your best endeavours, young Boulos, I got the numbers out in the headlines. Look, so let me tell you how this works, ladies and gentlemen. Ben and I'm a left-hander who puts my notes on the right-hand side. You're a right-hander who puts your notes on the left-hand side. I was trying to get the flashes out, literally. You move your notes inadvertently, I appreciate that, to hide the flashes, literally as I'm trying to break them into headlines.
It was not intentional,
I know
promise.
it wasn't. It was very funny. We got there eventually. Good morning to you.
Good morning to you too.
UK June core CPI ex energy, food, alcohol, tobacco up 2.6%. Reuters poll was up 2.5%. It's the core figure, okay? But the overall June CPI up 0.1% on the month. In line with expectations, June core CPI ex energy, I love this, ex energy, food, alcohol and tobacco. Is there anything left, I hear you say? Was up 0.3%. That was mildly higher than the up 0.2% expected. I kind of want to do RPI, but I always have Paul Donovan from UBS's words in my head. Oh, RPI is useless. So anyway, I'll do it anyway. It was up 3% on the year as well. So I think it's fair to say that the inflation data was pretty much in line with expectations, Ben.
Yes, indeed. And that will come as a relief, I suppose, to someone in particular, the new Prime Minister, Andy Burnham, who has held his first cabinet meeting, telling his newly appointed colleagues that they need to be a cost of living government. Burnham announced early on Tuesday he intends to cut VAT on electricity bills, but questions remain over how that will be funded. Addressing his colleagues in Downing Street, Mr Burnham outlined the scale of the task ahead.
We need to every day think, well, what can we do just to take that little bit of pressure off people's shoulders, just to give them that little extra sense that help is coming, so that they can have that bit of hope that things are getting better. And that's the mission that we've got to set ourselves together. We need to be a cost of living government, and getting that cost of living down, looking at all possible ways of doing that. I talked yesterday outside in Downing Street about bringing back hope.
Well, I hope you're not all feeling seasick after looking at the camera work. I mean, I think if you're going to televise these, sir, you need slightly better camera operators, dare I say it, I'm sure our camera operators here at CNBC can give you a few tips as well. Anyway, the newly appointed Prime Minister is already coming under pressure to extend a tax break for businesses employing people under the age of 25. The call is coming from the House of Commons Work and Pensions Committee, which argues that cutting employer national insurance contributions for all employees under that age would boost employment. Unemployment among the 18 to 24-year-olds now stands at an almost 15% level. That is a 12-year high. Let's get to Hetal Mehta, who is Chief Economist at St James's Place. Lovely to see you. Good morning to you.
Good morning.
Well, let me ask you a very open and broad brush question so far. Do you think that Andy Burnham is going to be different from the other 6 Prime Ministers post-Brexit and actually get the debts down, stick to fiscal rules and grow the economy?
That's an incredibly difficult question to answer, isn't it?
Yeah, we don't really know, do we?
No, we don't. We still have, I'd say, quite little in terms of policy announcements. The new Chancellor, little bit of cost of living announcement yesterday, but in terms of the really big picture stuff, we really don't know.
So, Heta, I was dismayed by yesterday's 45p cut to annual electricity bills in the form of a VAT cut. Not because people don't need the cut, I think people are struggling out there as well. But I thought it was very performative. I thought it was making a measure on day one when actually the real work isn't going to be as flashy and headline driven. The real work is actually getting the government spending down across as many departments as possible, so that the cost of financing UK government debt and therefore interest rates as well can come down, because the gilt yields will come down as well. And I made the point yesterday on the show that we traded a massive premium to equivalent and some economies I didn't think even were equivalent on the continent, and we therefore households in the United Kingdom and the sovereign pay vast amounts more for borrowing, whether it be on mortgages, whether it be on fiscal spending as well. If we do the unflashy stuff, then the other stuff can come.
I take a slightly different view on the cost of borrowing for the UK. So if you actually adjust for the fact that the Bank of England interest rate is, say, much higher than the ECB interest rate, and you adjust for any currency risk, etc., gilt yields look pretty much in line with US Treasuries and German bonds. So at the moment, it doesn't look like there's any sort of particular premium. But yes, if inflation could come down and if the Bank of England could reduce rates, then that will bring gilt yields down and cost of borrowing down.
Sorry, I don't understand. What is the risk that is negating the fact that we are trading at over 100 basis points higher than the Italian BTPs, rather than, forget about the bunds?
Well, our interest rate, the Bank of England base rate is higher.
And why is that?
So that, well, because we have higher inflation.
It's not just because of that,
I think
is it?
that's a large chunk of why.
It's not just because of that, is it? It's because there are huge concerns about the fiscal position, and there are huge concerns about the management of the UK economy, isn't it? We didn't trade at a higher gilt level during the quasi-Kwarteng Liz Truss budget because of purely inflation, and we didn't trade at a premium under Rachel Reeves purely because of inflation. There's a lot of other stuff going on here.
At that point in time, absolutely, we saw fiscal stress, and that was more evident in the gilt market back then. I don't think we're seeing that quite to the same extent currently. So I think a lot of it is explained by Bank of England policy, and we could have lower interest rates if inflation came down. But again, I don't think the current situation in the Middle East is conducive to that.
Fair enough.
In terms of what he could do on tax, it looks like sort of raising the personal allowance level, the tax-free personal allowance, is going to be tricky in terms of how they fund that. What do you think are the tax measures that you'd like to see that would help give UK economic growth a shot in the arm?
So I think the tax measures that are likely to have the biggest impact are ones that are incentives for businesses. Because as we discussed, as you mentioned, we have high employment taxes. That's disincentivizing employment, particularly for young people. So the NEETs, as we call them, not in employment, education or training, that's getting very high now, so about 14%. If you don't have the incentives for businesses to hire people and also to make capital outlay, so investment, we're going to be stuck in a rut of low productivity, low growth, and therefore low job creation. So that's where the focus needs to be.
I'm just intrigued. So in the bigger context of one of the other things, the themes that we talk about very often on the show, which is AI, even if you give firms an incentive in the tax system to hire more people, if they are already moving in terms of replacing lower level entry jobs with automated processes, however attractive the tax system is, it's never going to be as cheap as using agentic AI or an automation system instead of a human.
I think the evidence so far suggests that AI, whilst it's obviously developing very fast, it's enhancing existing tasks, not creating new work. So the chance of it displacing workers for a very long time, I think that's limited. At the margin, it may be making it a little bit cheaper to invest in a bit of AI rather than, say, some young, inexperienced person. But actually, as with all technological waves, there will be new work that then gets created and new jobs that get created.
I mean, the measure you mentioned about trying to incentivise businesses to take on workers through more attractive taxation regime is one thing. In terms of the bigger picture thing of what the city needs to ensure it stays competitive on the global stage, to make it an attractive place, to make London an attractive place to list, to grow, to scale a business, what are the big headline things you think the Chancellor, John Healey, needs to do?
I think it's pretty nebulous because many chancellors have tried. If it was really obvious, I think it may have been done by now. I think it is actually a combination of different things that just reduce the policy uncertainty. So we've just had, say, as seventh Prime Minister in the space of such a short amount of time. We've already lost count of how many new chancellors we've had in that time as well. What we need is a reduction in policy uncertainty, and that will also incentivise businesses to list here, but to make those long-term commitments. But let's also put it in context. UK economic growth, our potential growth, is probably around 1%, and we try and compare ourselves to the US, where they have stronger population growth, they have stronger investment, and their kind of natural run rate of growth is probably double what we have. So we also need to recognise that a 1% growth rate is probably not a bad outcome for the kind of underlying fundamental setup of the UK economy.
Andy Burnham has said that he will stick to the fiscal rules, but has also said he will look for wriggle room, flexibility within them. Do you think the bond markets will accept that, or will they look at that and think, you're abiding by the rules, maybe in letter, but not completely in spirit, and punish him as a result?
I think what we've seen before is when chancellors butt up against that fiscal headroom and use that, to the limit, then the tiniest growth miss, the tiniest overshoot on inflation calls into question how much wriggle room there is, and then we get into that horrible situation of speculation, thinking about, are we going to see another round of tax increases? So I don't think there is actually that much wriggle room. So I've seen some estimates suggest that the OBR's 23 billion estimate of headroom back in March has been eroded quite significantly. So maybe it's half of that now. So using up, say, 10 billion, what do you do next time that there's a small growth miss? You can't stick to the fiscal rules if there's no tolerance there at all.
Very quick word. Your clients, our viewers, they tend to be medium to high net worth individuals as well. I think that's fair to say. And they certainly have they try to be very active on observing how they minimise their tax bills, which is nothing wrong with that at all as well. Do you think their tax bills are going to go up?
Well, the latest projections from the OBR obviously was for the tax burden in aggregate to go up. And within that, what we've seen over actually decades now is that the tax system has become even more progressive. So the highest earners are paying an ever-increasing share. Again, we still don't know enough about the current policies, but that seems to be at least some of the direction of travel from the speculation in terms of whether it's a 50p tax rate. Maybe that's been walked back, but I don't think anyone is going to be ruling anything out.
So I know we're going to move on. We've got to guess. But 50p equals 52p. Well, we shouldn't be stupid about this and ignore the fact that we already pay 47p if you were an additional top rate payer. Because I think there's, again, disingenuous from various governments who say, oh, it's 45p, but it's not 45p, it's 47p, isn't it?
Yeah, that's right.
Hetal, thank you very much indeed for that. Hetal Mehta, who's Chief Economist at St James's Place. Ben, moving on.
And if you want more on the UK situation, it's well worth checking out Ian King's latest newsletter. It's out now this week, focusing on foreign takeovers of UK-listed companies, or as he puts it, the Great British Sell-Off. And still to come right here on the show, Santander's net profit rises 17% as the lender says it's on track to meet its targets for the year. We'll have the latest after the break. Plus, President Trump threatens an attack on Iran's Pickaxe Mountain nuclear site. More on that later this hour. And we'll be joined by the CEO of AkzoNobel as the company reports its latest earnings. That interview at 7:40 this morning, London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. All right, there's many things going on, but let's say three things going on at the moment. One is the oscillation that we're all seeing over semiconductors and technology-related stocks as well, and what a lovely roller coaster for all of you on a daily basis that is. Yesterday's move on the US markets was a northerly direction for the Nasdaq and for technology stocks and semiconductors as well. A second thing, of course, is we're all keeping an eye on what is going on with the war with Iran, and the oil price is continuing ticking up as well, which is a bit of a negative for the market. What was a positive, though, was without doubt the earnings season. And we're only in the foothills of the earnings season, but a couple of companies reporting yesterday, the likes of 3M, which beat, and the shares rallied around about 7%. GM also up around about 5%. So the earnings beats are actually slightly more than the historic levels at the moment. We normally beat at somewhere between 68 and 73% as well. We're beating at around about 88%, albeit with only a sampling of 66 out of 500 companies that have reported so far. Alphabet and Tesla still to come in the next 24 hours. Let's take a look at the Asian session and where we are on the key indices there. Wow, look at that. A rather tame performance from the Kospi, which has just been extraordinary in some of its big moves. Maybe some of that clamp down on the leverage plays having a bit of an effect there. But it's trading up 0.7% at 67.96. Elsewhere, the Nikkei is down. The Hang Seng down 1.2%. European futures look like this. On the equity front, we are called higher across the board.
The Spanish lender Santander says it is on track to meet its targets for the year. That's after second quarter net profit gained by 17% to €3.8 billion, which is slightly better than forecasts. I'm delighted to say that Jose Garcia Cantera, the CFO of Santander, joins us live on the show now. Just explain for us where that increase in profit came from.
Good morning. This is the first quarter where we incorporated TSB, although in the numbers TSB, it's a relatively small amount. Most of the improvement comes from the 12 million new customers that we added in the last 12 months, in addition to, obviously, the operating leverage that our digitalization, what we call internally One Transformation, means for the bank. This resulted in NII up 7% year on year for the first half, with fees up 9%, and we are increasing fees per customer. Cost to income was 42% as a consequence of the fact that costs were actually down in absolute terms, and cost of risk was flat. So the bottom line, as you said, increase the recurring bottom line in the first half was 7.3 billion euros, increasing 15% year on year.
Now, if, let's say, a new incoming Prime Minister saw these figures and thought, blimey, these banks are doing pretty well, they could weather a bit of an extra tax burden in order to pay for investment and infrastructure to boost the UK economy. How concerned are you about this idea that's been floated in the UK?
We've been in the UK for over 20 years. We are the largest investor in the financial sector in the UK and one of the largest investors in the UK as a country. We just, as I mentioned, incorporated TSB into Santander. So we believe that the UK is a great country to do business in and to operate. This is early days. The government is being formed as we speak. Is forming as we speak. And in any case, as we've mentioned in the past, taxes that are, let's say, that target a particular sector or a particular group of companies generally distort the economy. And in the case of the banks, this is particularly important because of the role that banks play in the growth of the economy.
So am I correct to take it that you would caution Andy Burnham, the Prime Minister, against such a move?
Well, again, we believe companies, individuals must pay the right amount of taxes, but the tax regime must be, let's say, homogeneous and must be fair to all participants.
All right. Jose, first of all, my colleague has missed the big story, and that is congratulations to Spain. Oh, my goodness me. We're all very, very pleased to see you do well, of course. So fantastic. I mean, that is the great story. Actually, on football, why don't I just go there as well? Does it have any effect on people's appetite to go out and consume and to actually take on more Santander services?
Well, thank you. It was wonderful to see Spain win the championship. I think the team did a great job. And all the Spaniards are very, very proud of what the team achieved. In terms of economic impact, we don't think it will have a massive economic impact. It will be negligible. But again, this is a good feeling. It's a good feeling for Spain, and it's great to see Spain winning the championship.
Yeah. I have to say, if England can't win it, then I'm very happy that Spain did as well. Look, let me move on. And one of your biggest markets, of course, Brazil, big LatAm market, tariff threats left, right and centre. Who knows what's going to happen electorally as well. How's Brazil faring?
Very well indeed, given the fact that rates are not normalizing as fast as we thought. Rates are around 15%, close to 15%, which means that real rates are around 10%. And obviously, this is, putting pressure on the economy, despite which the economy is doing very well. And we are actually doing very well. We earned a return on equity in the country of close to 15%, with NII expanding, cost of risk under control. It was, in terms of countries, it was the second largest contributor to our profit in the first half.
Yeah, and I guess I probably should just go northwards then as well. You are headquartered in Boston, I understand, for your US group. Over $165 billion in US assets as well. What about that operation? Is that performing as well as Brazil and elsewhere?
Yes, as you know, we are waiting for the approval for the Webster acquisition in the US. We got the OCC approval already, and yesterday the ECB gave us the approval on from their side. We are still waiting for the Federal Reserve approval, which is on track. From the beginning, we expected Webster to be part of the bank in the second half of the year, so very much on track. The business is doing very well, as you see, with all the components of the P&L doing very, very well. And the return on equity we got in the US was 13%, which is the highest ever that we have achieved in the country. So even before the Webster acquisition and the integration with Webster, our US operations are doing very, very well.
Very good. Look, whether it's United States, Brazil, or indeed back here in Europe as well, interest rates are higher than everybody would have thought they would have been at the start of the year because of various factors, tariffs to a certain degree, but certainly because of the war with Iran and what that's doing to a whole host of prices as well. It's very lazy for this journalist and other journalists to say, OK, higher interest rates, better net interest income, better net interest margins as well. Of course, it comes at a cost as well, and it potentially comes at a cost of delinquencies. How does the equation look to you at the moment, Jose, in terms of higher interest rates and what that's doing economically?
For the past 6 months, we have been living in very volatile times. From the trade situation to the war in Iran, it's been a very volatile few months, despite which the economy is being very resilient. And this resiliency is demonstrated in labor markets. Labor markets are very, very strong. New jobs are being created, unemployment remains very much under control, and this is the key variable for asset quality. So what we are saying is raising rates is good for NII. We are monitoring very closely, obviously, the credit quality of our different businesses, but so far there are no signs of asset quality deterioration. In fact, in 9 out of our 10 main countries, asset quality improved in the last 6 months relative to last year.
Can I just ask you why you think that is and if you're surprised by that? I'm surprised by it, Jose, as well. I look at some of the financial tensions, I look at some of the gearing, and I would expect a slight deterioration in credit quality and increasing delinquencies. Why are we not seeing it this time round?
Again, because people are keeping their jobs and new jobs are being created. And yes, it's true that we are talking about higher rates, but from relatively low levels. In Europe, rates went up from 2 to 2.25, maybe go up to 2.5. These are really low levels. So if people keep their jobs and interest rates are at these levels, maybe a bit higher, their capacity to repay their debts remains intact.